before we look at what the book says about dividends, I just want to point out, so interest income, again, that's where the tax-exempt interest goes, so it would not be taxable. Taxable interest income goes here, so these would be two separate amounts. This is not part of the same amount. It's not like total interest, but adding these two together would be the total amount of interest. So it's not, and I say that because it's a little bit different for the dividends. And you'll see when we talk a little bit more about those. So for example, if you have municipal bond interest of $200, but you also have a bank account and you received interest income of $50, then you would have $200 listed here, $50 listed here. So the total amount of interest that you received was $250. Okay. Dividends are entered on line 3, and you see there are two boxes for dividend income. We have qualified dividends, and we have ordinary dividends. Now, these two are a little bit different. Qualified dividends are part of ordinary dividends. So if you had $200 of qualified dividends, they are also ordinary dividends. So if you had total dividends of $400 and qualified dividends of those were $200, you would have a $200 here for qualified dividends and $400 listed here of ordinary dividends. The qualified dividends, get special tax treatment. They have their own tax rates. So all those tax rates that we talked about in chapters 1 and 2, how we calculated all of the tax on that tax liability, anything in this box is going to have a special tax rate. So what we're going to have to do is extract amounts in that box from our taxable income, and we're going to have to calculate tax on two separate batches of income. Okay, I'll give you some examples, and we'll go through how to do that. But what I just want to make that clear, that any amount that is listed here when you're figuring tax liability, and I get this question so much, I get it repeatedly from students. They'll get down here, they'll have a problem with qualified dividends. They'll get down to the bottom line, and they'll forget to subtract that amount out because we've got to tax that at a different rate. And they'll try to they'll apply the tax liability on the total amount here, and they'll be like, it's not working. I'm doing it, I'm looking at the tables. I'm like, because that amount has not been subtracted and taxed separately. So I'll show you how that works with some examples. Okay, so we're all hopefully familiar with what dividends are. They come from corporations. They could be S corporations or C corporations, but they're amounts that are coming out of retained earnings from companies. So the company, through the goodness of their heart, have decided to pay out to their shareholders some of the cash that they've earned during the year. Amounts that they had some earnings, and they're going to pay it out and share the wealth with the shareholders. So they are generally taxed at what we call capital gains tax rates. So, and kind of make note of that terminology, because when we talk about gains, we will talk about capital gains, and these tax rates will come back. That's chapter 7. We will use them again in chapter 7. If the dividends are paid from a corporation's current earnings and profits, or it's accumulated earnings and profits, then it's called a qualified dividend, and it gets a special tax rate. It gets a special lower tax rate. What happens with dividends, when I say it's from the goodness of their heart, it means they're not getting a deduction for paying those dividends. They're just paying it. They're not getting any tax benefit from paying out dividends. It does not reduce their taxable income to pay them out like other expenses. Like for a corporation, they get revenue, they pay wages. Those wages then are a deductible expense that reduces their taxable income. Dividends, they pay them out, it doesn't reduce their taxable income. They get no tax benefit from it. But then so they get no deduction from it, but the recipients of those dividends have to pay tax on it. This is where the concept of double taxation comes in. I don't know if you're familiar with that. People will complain about double taxation. There's this general rule in tax where you're going to have two sides to every transaction. On one side, one party has income while the other party has a deduction. So the example of wages, the corporation pays wages to the employee. The corporation has a deduction because they paid wages. The employee has income. So there's always these two sides to every transaction. Somebody has income, it means that somebody else has a deduction. Well, when it comes to dividends, that is not the case. When it comes to dividends, the corporation has no deduction, but the recipient has income. So that income or that dividend amount has been taxed twice. It was taxed at the corporate level because they weren't allowed a deduction, and it was taxed to the recipient because they have income. So you don't have that balance there. But what you do get instead is this more preferential tax rate for dividends. It doesn't make up for it 100%, but it helps to equalize it a little bit. So instead of the dividends being deductible, the recipients are now going to pay a lower tax rate, but only if certain conditions are met. And the conditions are that the dividends have to be paid out of the earnings and profits. So the company can't go out and borrow money and then pay dividends. That's not a qualified dividend. They have to it has to come from either their current or their accumulated earnings, so their retained earnings over the years. Any distributions in addition to earnings and profits would represent a non-taxable return of capital that reduces the taxpayer's cost basis in the stock. This is getting a little bit higher level. We'll learn more about this again in Chapter 7. If the distribution is greater than the basis of the stock, the excess would be a capital gain. For our purposes, we're concerned about our qualified dividends right now. Those dividends, those amounts that are paid by a corporation that are not in excess of our earnings and profits. So they came right out of what the company had in their retained earnings. So normally dividends are paid in cash, but sometimes they can be paid in property. You'll find that more common amongst closely held companies and smaller companies. Or they can be paid in any economic value. The basis of what is received as a dividend in the hands of the shareholder is the property's fair market value at the date of distribution. So if a company gives as a distribution, let's say a car, that's a silly distribution, but if a car and its fair market value at the date of the distribution was $5,000, then the amount of the distribution is $5,000. That's what they're saying. Not what the company paid for the car, but what the fair market value is on the date of the distribution. Companies can also distribute dividends in the form of stock, giving additional stock instead of cash. Maybe they don't have the cash on hand, but what they're going to do is they're going to give more stock. Unfortunately, that only dilutes the existing shareholders, but stock dividends are not taxable to the shareholder, except in a couple of cases. So the stock dividends, if the stock dividends in which a shareholder has the option to receive cash or other property, they would be taxable. So if the shareholder has that option. Disproportionate dividends, where some shareholders will receive property, others will receive an increase in their stock. So if it's any type of unequal distribution. Preferred stock distributed to common shareholders, and then other distributions made on preferred stock are considered to be taxable. A little side note here about mutual funds. So mutual funds are pooled investments. So it's like a grouping of different companies, shares from different companies. And so when you have that, oftentimes you will have dividends. Certain companies will be paying dividends. They pay them into to the mutual fund owners. So the mutual funds are required to distribute the income that they receive. They can't reinvest it and purchase more. So what they do is those who own the mutual funds will then, even if they don't, they can reinvest the dividends that they receive overall into shares of the mutual fund, but they can't reinvest it into individual shares. But anyway, the mutual fund holders will then have taxable dividends from that. So they'll receive dividends from those mutual funds. Okay, so how does the tax work? So, like I said, there's different tax rates. I really can't stand that they put this in a paragraph. I wish they would just put it in like a table like they did all the other tax rates. So, at the back of your book in the one of the appendices, this is written in table form, but I'll write it down here now. So, the tax, so this is qualified dividends. Again, they have to be qualified dividends. And it says on the form, you'll see when I show you the 1099 DIV, dividends. So these are our tax rates. So married filing jointly, 0 taxable income to 94,050. The tax rate is 0%. So if the amount on line 15 is 94,050 or below, then the tax on those qualified dividends is 0. If they have $1,000 of qualified dividends, they're not going to pay any tax on it. Let's see, head of household. Oh, they've got the different, what are we doing here? See what I'm saying? This is, married filing separately. Okay. Married filing jointly. So from 94,051 to 583,750, the tax rate is 15%. And then up to, okay, and then 583,751 to infinity, it's 20%. Okay, I'm just going to write the married filing jointly up here. Like I said, the appendix has this displayed a lot more. It's a lot more readable than what they've got here. But you can see, so first off, we've only got 3 tax rates. And the first one is the best tax rate ever. It's 0%, right? So if you're married filing jointly, and so that's your filing status, and on line 15, that last line on page 1, it's this amount or below, then any amount that was listed as qualified dividends is going to have a 0% tax rate. So there you go. The tax rate schedules are in Appendix F. Here's an example, and this I'm going to show you on the tax form as well what this is going to look like, but I'll go through this also. So we've got a single individual. So our single rates, of course they're going to do single, 47,025 for single. So 0 to 42,025, and then 42,026 518,900. That's a big range. And then 518,901 to infinity is at 20%. So there's the single rates there. All right. So we got a single individual. Taxable income is 110,000. Well, 110,000 is between 42,026 and 518,900. So any qualified dividends that they have are going to be taxed at the 15% tax rate. Now, if they've got, well, we'll see. I'll show you what it is for their ordinary tax rate. So what we do, and we do this taxable income before the dividend. So subtract the dividend first. So take line 15 and subtract that qualified dividend to determine what the taxable income is before the dividend. So they say it's 110,000 and they had a $1,000 dividend. So their total taxable income was like 111,000. This first calculation is doing what you've already done, figuring out what the tax is on the rest of the income. So if you have included, what you want to do is figure the tax on the income before the qualified dividend. I'll pull up the 1040 in a minute to show you how this works. And figure out what the tax is. They've done that. This is the same calculation you've done. So they subtracted the lower bracket amount. The remaining amount was taxed at, so they're in the marginal 24% tax bracket. Tax on the first 100,525. They added those two together. Total tax is 19,443. That's their ordinary tax. But now we have to add the tax on the dividend. So $1,000 of dividend at 15%. They're paying $150 of tax on that dividend. Now we add that to the ordinary tax. Add those two together. Total tax liability is $19,593. Look at what it does. If this dividend had not had special tax treatment, they would have paid $240 of tax on that dividend because they were in the marginal 24% tax bracket. But because it's a qualified dividend, they're paying $150. So they're saving $90 in tax because of that special tax rate on the dividends. Let's see. Let me show you here. So this is a 1099 DIV. Box 1 is total dividends, all the dividends. Box 1B, sorry, 1A, total dividends. 1B, qualified dividends. So of those total dividends, how much are qualified? The only ones that get special tax treatment are the qualified ones, the ones in this box right here. Okay? Those are the only ones. No? Yeah. Thank you. So when you're looking at these forms, if there are no qualified dividends, which means it didn't come from a company where it came from the earnings and profits, there will be nothing in that box, 1B. There's always going to be something in box 1A if you received dividends. There might not always be something in box 1B. If the two of those boxes are the same, so let's say it was $1,000, $1,000 here and $1,000 here, that means that the total dividends received were $1,000. Of those dividends, all of them were qualified dividends. Okay. I don't know that there's anything else on that form that you guys need to be aware of right now. All right. So let's look at, let me show you an example here. So let's make believe here. let's say we've got somebody who is married filing jointly. They had, let's say $250,000 of wages. And they've got qualified, so total dividends of $7,500, qualified dividends of $2,000. So on the 1099, this would be in the first box, the $7,500, and then $2,000 would be in the box, that second box. So box 1A, box 1B on the 1099. So we've got total income, these two amounts, so $257,500. Nothing there, so $257,500. Standard deduction is what, $29,200 because they're married filing jointly. So $228,300. All right. This is what we got on our line 15. First thing we're going to do, we're going to take line 15 and subtract line 3A. Okay, so let's see if I can do this in steps that make any sense. I'm going to erase these. So step 1, line 15 minus line 3A. So here we've got $228,300 minus $2,000, so $226,300. Now we're going to need to go to our, not our tables because that's over $100,000, but our schedules. And do our calculation. Use this schedule. So single, married filing jointly. You guys all know how to do this. So we're going to take the $226,300. We're going to apply, so they're at 24%. All right. So 226, so 201,050. 250. So 25,250 times 24% is, my calculator's back here. If I still have it, that is. Maybe I don't. Maybe I do, maybe I don't. There it is. All right, so 25,250 times 0.24, 6060, plus 34,337, so 97,3. Okay, so 43.97 on our ordinary income. That's our subtotal there. We're going to go back. So that's the amount of tax on our ordinary income. You can see we didn't include the dividends in this amount. Now we've got to figure the tax on the dividends. Actually, that's not. Let's see. So this is step 1, and then this is kind of step 2 here. That's calculate tax on ordinary income. is here. Step 2. Step 3, calculate tax on qualified dividends. So we have $2,000 of qualified dividends right there. Our tax rate on those dividends, because our taxable income before dividends is $226,300, that means we're in the 15% bracket for dividends. So 2,000 times 15% is, what do we have, 300? Is that right? 15, yeah, 300. $300. Step 4 is add step 1 and step 2. I'm sorry, step 2 and step 3. So we've got 4397 plus 300, 4697. This goes on line 16. Can you guys see that? Not really, because all these are in the way. All right, so again, first thing we're going to do, I'm going to take line 15, do everything here, put everything on the form, take line 15, subtract line 3A. Okay, so this gets us to our taxable income before qualified dividends. Calculate the tax on the ordinary income. So now we've got all of that before, we've got the ordinary income before dividends. So now we calculate, do what we've done. We know how to do that. Use the appendix F to do that calculation. Calculate the tax on the ordinary income. And then we're going to take those dividends and we're going to apply the tax rate, the appropriate tax rate, based on this number. So whatever this number is, that's the tax rate we're going to use. For most of your problems, it's either going to be 0 or 15%. But I tell you what, the biggest issue that students run into here is they forget to do this part right here. They just calculate as though there were no dividends, as though there were no qualified dividends. They forget that the qualified dividends are at a different tax rate, and that the two amounts have to be calculated separately and then added together. Okay? Got it? All right. Let's see.